Good morning and welcome to the CG Asset Management Q3 investor presentation. Throughout the recorded meeting, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Sophia Sednawi, Head of Investor Relations. Good morning.
Good morning. Thank you so much, Paul. Welcome, everyone. For those of you who don't know me, I'm Sophia Sednawi, Head of Investor Relations at CG Asset Management. Very happy to be here today with Alistair Lang and Hassan Raza from the fund management team. First, I'm going to get the admin part out the way. So please refer to our disclaimer here. Essentially, investments can go up and down. And nothing we say in this webinar should be taken as advice. The team will shortly be giving an update on what's been happening over the quarter, as well as key themes and opportunities that they're seeing in the market at the moment. You will see some performance and allocation information from Capital Gearing Trust. It's worth remembering, however, that the team's macro views and allocation decisions are relevant for our entire fund range across both multi-asset and fixed income, as you can see on this slide. I would also, while I have you, like to flag that if you'd like to see the team in person, we are actually hosting our Investor Day on the 5th of November. So do reach out if that is of interest. And another couple of dates coming up are the Capital Gearing Trust interim results on the 18th of November and an index-linked bond seminar we will be hosting in January. And on that note, I will hand over to the team for their update.
Thank you. Good morning, everyone. If I may, I'd like to focus on three things. Our performance, the largest changes to our holdings over the last quarter, and why I think discounts will narrow, both naturally and with some help. Looking at performance, it has of course been a quarter where markets have shown how brittle the plumbing is. Investors who had grown accustomed to benign volatility in Japan were carried out when the yen appreciated violently at the start of August, the impact of which reverberated across global equity markets, particularly US growth stocks. Over the last quarter, the yen has appreciated 12%. And as you know, the portfolio has been positioned to benefit from this. The remaining exposure to the currency is 9%. But it was also pleasing to see all of our asset classes contribute positively to performance, both over the quarter and over the last 12 months. So where does that leave the portfolio today? Well, the two largest changes to the weighting have been a 3% increase in our risk assets and a 10% decrease in index-linked bonds. On risk assets, we took the opportunity to deploy some dry powder to UK and Japanese equities around those turbulent weeks of August. We have subsequently taken profits in several positions that have performed well. Now, whilst investment trusts remain attractive, 36% could well be the high point in the cycle for risk assets. This is because volatility is elevated heading into the US election with significant tail risks. The economic data is not harmonious, and global equities remain vulnerable to a correction in the US, which is priced with inadequate room for error. For fixed income, for index-linked bonds, nearly all the weight has come out of the UK from the maturing July 24s. Proceeds have gone into treasuries where we see better relative value. There's also been a modest increase in the US, where our duration is longer at 8.7 years, and we favor tips on valuation, currency, and portfolio insurance grounds. Looking back longer, and I've taken this data as far back as Bloomberg allows us to disaggregate it, Both our bonds and equities have contributed to performance. In particular, as you can see, the risk assets have widened their outperformance against the investment trust sector over the last quarter. Actually, on the investment trust sector in particular, I have been asked by many of you this year if the sector is destined to shrink to irrelevance. So the case I put forward is this. The investment trust sector has not just survived, but thrived over the years. Assets in the sector have grown 10% per annum over the last 20 years on average. It has been the fastest growing in market cap and the most dynamic, at least in the number of new companies listing in the part of the all share. It has outperformed UK equity markets and for most of the last 20 years, global equity markets. In fact, discount expansion explains about 2/3 of the underperformance in the last few years. And discounts have indeed been wide. In fact, at their widest levels since 2008. But should these discounts narrow, and I think they will, in fact, they have already started to, then there is a strong historical track record for outperformance. I believe these discounts are cyclical and part of the healthy Darwinian rhythm of the sector since 1860, in fact. And there are several catalysts at multiple levels to accelerate this cycle. At a macro level, you have the rate cycle turning. We have better balanced allocations to fixed income. Multi-asset redemptions have slowed, and cost disclosures will help at the margin, I think. At a sector level, we saw rampant issuance over the last few years, creating an oversupply of shares with price picking up the slack. But there has been a record return of capital through buybacks and corporate actions, which is accelerating. Last year, we saw 15 mergers, realizations or wind-ups. Year to date, we have seen at least twice that either announced or completed. So the sector is not waiting around, and it's pulling its returns up by its bootstraps. Stock-specific level, governance has improved over the years. Boards are much more willing to engage, especially with us, we are told. We're not seen as transient activists. We have built enduring relationships with boards over the last half century. One recent example, and perhaps a more public engagement than we would like, is PRS, one of our largest property holdings, who released results today. I should add that whenever possible, we would much rather prefer to do things privately. In this instance, noting the discount, the generously long contract awarded to the manager, and the additional fees from a potentially conflicted third-party advisor, we submitted a requisition notice to call for an EGM to appoint Christopher Mills and Robert Naylor to the board. There were constructive conversations. The chair has stepped down, and the strategy is being revamped with the new board, and we've withdrawn our notice. Shares have rallied 35% over the quarter, and we expect this to improve as PRS moves into the 250. As well as PRS, there has been a notable increase in the number of special situations and merger arbitrage positions this quarter, and we look forward to updating you all on their progress in due course. So to conclude, performance has been resilient, and we are constructive that risk assets will deliver outperformance.
Great, thank you, Hassan. And good morning, everyone. For those who don't know me, my name is Alistair Lang. I'm the Chief Executive of CG and on the investment team alongside Hassan. So today I'm going to look a little at the outlook try and gaze a bit into the future. And as Hassan has made clear in his segment, there's a lot to be optimistic about in terms of investment trust returns, which raises the valid question of why do we have a third of the portfolio in these opportunities? Why not more? And I think part of that relates to our concern about the prospects for the macro environment. There are quite a few warning signals that are flashing red at the moment. And I might just run through a few of those, but I'm going to start off really with a bit of a health warning. I'm going to talk about football and, of course, a breakout star of the 2010 World Cup, which was, of course, Paul the Psychic Octopus, who had an extraordinary track record in correctly predicting the outcome of a whole variety of games, including the fact that England would lose, as it turned out, 4-1 to Germany, and Spain would go on to win. Paul had the good judgment after an effective run of predictions to retire. So his psychic reputation was intact. But I mean, this is quite a slightly light-hearted way of bringing up the risks of some of the kind of indicators I'm going to look at. I guess maybe if we think something like the Goodhart law that says as soon as a measure becomes a target, the measure ceases to be effective. A number of these warning signals that I'm going to point to have some theoretical and other questions that can be raised about them. But it is notable how many of these are flashing red at the same time. So maybe I'll just jump in. Perhaps at the best known psychic measure within the financial macro area, and also one whose reputation is somewhat under question at the moment, and that is the inversion of the yield curve. The term inversion of the yield curve describes a situation when long-run rates are lower than short-run rates. And this is an inversion of the norm. Theory says that long-term interest rates should be higher than short-term interest rates to recompense investors for having their capital locked up for longer periods of time. And this measure was actually brought to prominence in the 1980s by Chicago University's economics school. And they pointed out, some of their PhD students pointed out that in every recession since the Second World War up to that point in the 1980s had been preceded by a yield curve inversion. Now, under Goodhart's law, we have now identified the measure and it should start misbehaving. But actually, the measure you can see here from the 1980s onwards continued to be an extremely good indicator of imminent recession. And we can maybe talk a little bit as to why that was. However, this measure has taken a bit of a knock recently. You can see on the far right of this chart, sorry, I should have mentioned that this chart shows the 2-10 spread. That is the yield of the 2-year Treasury over the yield of the 10-year Treasury. So when this line goes below zero, it shows an inversion. And you can see that the inversion on the right end of this chart was the longest and deepest inversion that has been seen certainly since the Second World War. And a number of economists, forecasters, and indeed ourselves were saying in mid-2022 when this signal came up, we started raising some concern that historically this had been a sign of recession. Of course, over the last 2 years, the US economy has been surprisingly strong. So it may be that this is an example of a signal misbehaving. It may be that the severe disruptions of COVID just created a situation where this measure was no longer relevant. Indeed, the pass-through of inflation may have really thrown this measure out. But there was an interesting recent paper by Jim Reed at Deutsche Bank that pointed out that the most proximate trigger of recession or slowdown is not, in fact, the inversion. It is the disinversion, i.e. the point at which the 10-year rises back above the 2-year. And this typically occurs because the 2-year starts rapidly falling, i.e. it is the steepening of the yield curve after the inversion that is the most proximate trigger. And that's certainly been the case, you can see in these recessions since 1980. It's the point at which this line, 2s, 10s line, goes back above zero that the warning signal really starts to flash. And this might just be a kind of an egregious case of data mining, but maybe we might think a little bit as to the theory behind why that might make sense. So on this chart, we've got the US yield curve today and the US yield curve a year ago, which is above it in the green line. The US yield curve today is in the pink. These look disarmingly like a couple of Paul's tentacles curling out there. I would say the curve a year ago was an almost perfect example of an inverted yield curve, other than in the 20-year period. Each of these benchmark bonds is lower than the bond preceding it. So why might this kind of setup be a signal of an impending recession? Well, the theory goes, or at least the heuristic goes, that an inverted yield curve tells you that some point out there in the medium term, the interest rates are going to be coming down potentially quite fast. So that's why you get this distinctive offset. And indeed, as we roll forward to the pink line 12 months later, you can see that the inversion has, we have disinverted at every point other than the 1-year bond. And given that interest rates have recently dropped and that there are 8 forecast interest rate cuts implicit in this curve before the end of next year, clearly the bond market is saying that interest rates are coming rattling down, and that will only occur in a period of soft economic growth. So, you always have to have a warning sign that there could be, particularly the kind of very elevated burst of inflation might have thrown this measure out somewhat. But certainly we can see this measure is suggesting that the economy is weakening and that we are likely to face a number of interest rate cuts over the next 18 months. The Federal Reserve itself has pointed to another 2 interest rate cuts for the rest of this year. And the market is then pricing in another 4 next year. But it's not just, if we're thinking of these spooky, long-term psychic measures, it's not just the yield curve that has inverted. We also have another of these long-run heuristics that has been, if anything, an even better signifier of recession, called the SARM rule. This was made prominent by Claudia Sahm, a former Federal Reserve economist who was actually working at the Brookings Institute when she wrote about this measure. And this is a relatively simple measure. In the green line, we have the rolling 3-month unemployment rate. And her heuristic proposition was that if the rolling 3-month unemployment rate rises by more than 0.5%, then over the preceding 12 months, then that is an indicator of actually that you're already in an early stage of recession. And really the theory underlying this is that unemployment is a somewhat backward-looking measure. So by the time you're seeing rapid rises in unemployment, the economic situation is already moving quite rapidly. Now, I mean, this unemployment is a noisy measure. A number of you would have noted that the last payroll numbers was actually very strong. We'll have to see how it pans out. And also, again, you can say that the employment changes around COVID were just so stark and in such an unusual context that maybe the unemployment data is likely to be somewhat complicated for a number of years to come. However, it is absolutely, kind of notable that this, which is probably the most reliable indicator along with an inverted yield curve, is sending a warning sign at precisely the same time. So, yeah, just to come back to say these are heuristics, they're not fundamental laws. I said earlier that Paul had the good sense to retire. He actually died. And that is obviously from the point of view of his psychic reputation, that is the very best thing to do. It may be that all of these rules will be shown not to be in this scenario have quite the kind of forecasting capabilities. But if we look at a whole range of other indicators, it is notable that a lot of them are slowing. So I show here credit card debt delinquencies on the left. We can also see there's an incredibly low savings rate in the US, all of which points really to, I guess, the bottom half of the income scale in the US, probably really struggling. I suspect a number of the stimulus checks that landed during and post-COVID have now been spent. If we look on the corporate side here, you can see that CapEx expenditure, which kind of forecasts and orders which boomed after the Inflation Reduction Act, are showing quite a dramatic kind of reduction. We can see manufacturing PMIs and ISMs slowing down as well. And against the backdrop of the US economy running a kind of 6% current account deficit, i.e. the government is stimulating via a lot of channels such as the Inflation Reduction Act, it is quite surprising to see these synchronized measures of unemployment, capital goods, and a number of the kind of savings data softening all at the same time. So I think there is there's genuine reason to kind of pause for thought here. The US economy has been the absolute exceptional outlier of, China and Europe in particular have obviously been struggling over the last couple of years. It's really been the US that has been motoring along, and it's fair to say India as well. But there are reasons to be concerned about whether at least this element of US exceptionalism will continue. But there is one area of US exceptionalism which remains completely intact, and I guess this is the third of our kind of measures that has been held in high regard by investors historically, although somewhat questioned by a number of investors today. And this is the cyclically adjusted PE ratio, that is to say, the price of stocks based against their trailing 10-year earnings. It's a kind of fundamental measure of valuation that was popularized in March 2000 by Robert Shiller. He had been measuring it for a little while. But in his book, Irrational Exuberance, he published in March 2000 when CAPE hit 42, an all-time high by a long stretch. And that absolutely marked the peak of the dot-com boom and a subsequent unraveling. This measure kind of rose up strongly it fell down after the global financial crisis, rose up strongly again. It peaked in 2021 in the kind of COVID everything bubble. it sold off dramatically, but now at 37, it's in its 97th percentile, just below those peaks, but essentially at extremely elevated levels. And really what's been driving this has been a narrative of AI and the Magnificent Seven. They are a very significant portion of what's been driving this upward revaluation of stocks. And you really have that kind of combination, which is quite reminiscent of the late 1990s of very high equity valuations, at very least a slowing economy, that very strong tech narrative, which, by the way, turned out to be absolutely correct. The internet and communications revolution has transformed the corporate landscape. It's transformed how we all lead our lives, but it just took quite a long way to really impact the economy in a very substantial way. I'm not going to talk extensively about AI, but I would point out that Goldman Sachs recently brought out a paper suggesting that we need about $1 trillion of capital expenditure to roll out over the next few years. A great example of that was as Microsoft really essentially acquired via a 20-year power purchase agreement the US, the mothballed US nuclear plant, 3 Mile Island, that had the US's most famous nuclear disaster. But it essentially took this out of, this has been unmothballed, brought back into production in order to feed the extraordinary power needs of AI. And so I would just point out that, this is a very different type of foundation myth from, say, Mark Zuckerberg or whoever exemplified Jeff Bezos, the internet revolution. These guys in their backyard typing away software code, which was the ultimate CapEx light model. These AI revolutions come literally with nuclear power stations attached. It is extraordinary the amount of infrastructure that's required. So all's to say, there is a risk that we face unless there's a pretty short-term payoff in these extraordinary levels of capital expenditure. There's a risk that we face over the next decade, a situation a bit like what occurred in the 2000s, where you have profitability weighed on by write-downs of significant areas of capex. You have equity valuations starting at very high levels, and you have a slowing economy. Whether or not it goes into recession may not even be the central point here. It's just a very potentially difficult setup for investors. And in this quick kind of tour of the horizon, I wanted to touch on the bond market, which here we can see global real yields on a number of developed markets. There was clearly a massive repricing that occurred in 2022. But since then, as the Treasury yield curve showed that we were looking at earlier, we have typically come off the top of the real yield environment. And as we move into an interest rate reduction cycle, we have tended to see, in generally, real yields come off their 12-month high and move downwards, and some gains in the domestic value of these bonds. As Hassan pointed out, we did, particularly in the aftermath of 2022, with post the Liz Truss kind of debacle, we moved quite significantly into UK index linked. But it is now a number of the bonds that we've held, the interest rates have come down. We're beginning to see quite a significant spread has reappeared between TIPS and UK index linked. So once again, we've got a situation where we are holding, our largest holding is in US index-linked bonds. And if we look at these values in absolute terms, when you have 10-year real yields at just shy of 2 real, that's not historically stand out good value, but these do look like instruments that are fairly valued in the current environment, and indeed seem to have a bit of a tailwind now we've moved into a falling interest rate environment. So we think that there's a firmer backdrop for bond markets, even if we're not necessarily in the short term anticipating a move back to negative real yields across the board. So I'll just sum up, trying to pull those different threads together into how we have the portfolios positioned today. And as Sophia pointed out, we're talking here about Capital Gearing Trust, but this absolutely runs through the Absolute Return Fund, CT Portfolio Fund. We have about 30% of the portfolio in cash and short-run credit. We've actually been selling down some of our credit positions because they've performed so well and spreads have come in. But still, that overall portfolio is delivering us just shy of 5%. It's very high quality credit returns. We think regardless of the environment, whether we're going into recession or not, that is a sensible place to hold a portion of the portfolio so that we can respond to better values should they emerge in either the bond or equity markets. Then we retain a bit of duration in the medium term through UK index linked and over longer bonds in US index linked. These are all offering positive real yields, which is fantastic. We're not guessing that we're going to get a return over inflation. We know we're going to get return over inflation. And we have a bit of duration here that means if interest rates come down, we feel that we will continue to benefit from that. And then finally, we have just over a third of the portfolio predominantly invested in a range of investment trust opportunities that we're really quite confident now are going to outperform, for example, global equities over the medium term, over the next 5 to 10 years. Starting from the kind of valuations that we do today, the kind of discounts that we have today, as contrasted to, say, the Magnificent Seven valuations and those kind of Cape type valuations that look very, very elevated to us. But we only have just over a third of the portfolio there because, if we are entering a kind of early 2000 situation of weak equity markets, we want to make sure that this portfolio is not going to suffer significant drawdowns. And essentially, when you have 65% of the portfolio that we're confident will be delivering returns in our fixed income, positive returns regardless of the environment, that gives quite a lot of cushion, such that if our risk assets perform well and we're too bearish on the outlook and equities continue to thrive, we should still be able to deliver mid to high single digit returns across the portfolio, and that's absolutely adequate for a very low risk portfolio. But if we are facing tougher times, that engine room of defensive assets should mean that we can continue to grind out positive returns. So that's really how this is set up. And just as a final comment, I've been talking for a little while here, but given I was thinking a little bit about 2000 and 1999 and the kind of tech, the dot-com bubble, I looked back at the Capital Gearing Trust asset allocation from 1999, and there was then about 50% of the portfolio that was in short-dated nominal instruments. We had about 15% of the portfolio in longer-dated, predominantly index-linked government bonds, and then about a third in investment trust instruments. So although there was a much greater weight in those days, the short-dated nominal instruments were largely zeros, and that market is somewhat disappeared. This is a tried and tested asset allocation, and I just thought it was remarkable and interesting about how similar we're set up to where we were 25 years ago. So on that note, I will stop and I will hand over for some Q&A. And
That's-
yeah.
I was going to say, Alistair, thank you very much indeed, and Sam, thank you for updating investors over the presentation. Ladies and gentlemen, do please continue to submit your questions just using that Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those questions already submitted today, I'd like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard on the Investor Meet Company platform. So far, as you can see, we've had a number of questions submitted throughout today's presentation. Thank you to all the investors for submitting those. If I may just ask you to read out the question where appropriate to do so, and I'll pick up from you at the end.
Brilliant. Thank you so much. Definitely topic is the investment trust allocation. I'll start with the first question around cost disclosures. So given recent announcements from the regulator, are you encouraging the boards of the trust you own to update the reporting of their costs to zero? And likewise, are you doing the same for Capital Gearing Trust?
So I will not comment on the precise detail just because I don't want to get it wrong, but we're absolutely aligned with the general direction of that. We have changed the UK KID for Capital Gearing Trust. We're looking at our EU KID because the rules have not changed there, but yeah, we are looking at that. We are engaging with other investors and other investee companies on changing the OCFs. So there are lots of people taking advice, as you'd expect with listed companies. This is an important disclosure we don't want to get wrong, but absolutely this is the direction of travel. And I think for a number of companies, it will not be kind of game changing, but there are certain companies, particularly in the alternative space, that were undervalued for money criteria were being essentially, at the very least, flagged up, if not completely withdrawn from a number of retail platforms. So I do think there are cases for some of the really unloved investment trusts and the largest discounts to actually be positively impacted by this. So yeah, that's a great development for the sector.
I would only add, and perhaps not just related to disclosure, but we've been encouraging trusts to not just disclose but lower their costs over time, right? If you think about it, there's about 370 trusts in the space. 125 of them are under 400 million. They've traded on a double-digit discount for the last year, and they charge fees over 1%. So we may not agree with them on buybacks or wind downs or other corporate actions, but we can agree generally that lower fees are constructive to shareholder returns in the interim, particularly if there's not been any issuance or development activity. So we are challenging trusts that have had a period of underperformance on their fees frequently.
Great, thank you, Hassan. I mean, this leads quite well into the next question, I guess, from David. Thank you very much. With so many listed vehicles trading at significant discounts to underlying value, very much like PRS, do you anticipate becoming more active to realize greater value?
I would say we are active and in our preferred manner. The approach to activism more broadly should be outcomes based, I believe. When I compare the investment trust sector to my previous life in restructuring and workouts, the stakeholder base is much more diverse. There's a lot of competing interests. So I always come back to, yes, you want to be active, but you're going to create noise. What are the outcomes you will achieve, and will those be in a timely manner? And to that, I think, an activist approach that's quite noisy, that doesn't necessarily yield the outcome you want in a timely manner. It ties up a lot of capital. It increases the risk-adjusted return. It increases the risk side of the equation. So I think you have to think about a more active approach in the context of an outcomes based framework. Where we've done that publicly and historically more successfully is perhaps in the renewable space. We don't need to own a very large majority of the company, but we can influence the narrative and the story by marshalling together the shareholder base on a particular message ahead of a continuation vote. We can guide the company towards reducing their allocation to riskier asset classes and commit to doing that over a period of time. So I think it's about either taking a pragmatic approach and understanding the influence you'll have against the risks that you take when you're looking at this, and essentially put the guardrails around investments that either enhance returns or reduce risk over a period of time.
Brilliant. Now a somewhat more technical question, again related to trust selection. How does liquidity impact trust selection, and do we have a lower threshold in market cap, and how big is our target universe?
So I would say that liquidity is certainly a factor, but I would put the question in two ways. I think there's a defensive and an offensive element to how you think about liquidity. We are very risk conscious, and for us, defensively, looking at the liquidity of investment trusts is core to how we size the position. So, the outcome of all of that is that you can liquidate near enough 80% of the portfolio with a 20% participation in less than a day. So our portfolio is quite liquid, which allows us, which not just expresses the defensive nature of how we think about liquidity, but also allows us to be offensive when markets capitulate. So, when I think to March this year, when I think to October last year, we were a provider of liquidity. We were able to pick up large block size positions in trusts that we had been following competitively and on occasions below the bid. So I think, when we think about liquidity, it runs through our whole portfolio, and we have a defensive and offensive element to it. Does it limit our universe? Not necessarily, because I don't think market cap is necessarily the best way to measure it. I think there is trading off market. There is, a change in many of the structures we're seeing in trusts, new tender mechanisms, buyback activity. And so the historical volume or necessarily the market cap doesn't necessarily reflect the prospective liquidity we might view in a trust. So it doesn't limit our universe, but we are certainly conscious of it as a defensive and an offensive tool.
Okay, and just to, I guess, frame it a bit, I think, if I'm not wrong, the investment trust universe is about 200 billion of market cap, and there are about 350 trusts that we can invest in. So there's lots to go at. But liquidity, the illiquidity is what creates the opportunity as well. Typically highly liquid ETFs that can, in theory, trade at discounts to NAVs, they don't, because they're highly liquid. There's a very effective arbitrage mechanism. So the illiquidity is the source of the opportunity as well as the source of the risk. Absolutely, there are times when holding illiquid is highly risky. What we're seeing now, and we're being asked about, our top contributors, but the trusts that are moving most dramatically are the ones that are the least liquid, and then a small change in demand leads to a large change in price. So maybe, I don't know if I jumped ahead there, but
you're entitled to answer that question as well. So someone has asked us what the top 5 contributors and detractors over the last quarter were. I'm not sure if we have that data to hand, but I'm sure.
No, but we can certainly get it to you. But there's been property has and infrastructure have contributed strongly to the performance. Our holdings in Japan and the UK have contributed, but we can certainly come back.
Brilliant. Onto a more outlook question. So on duration and inflation-linked tips, if you expect a rebound in inflation, do you think the longer duration holdings risk a negative return again if interest rate expectations increase as in 2022?
Yeah, that's a great question. So the first thing to say is that I think we are more nervous about inflation than the market broadly. And we look at index-linked bonds today and think they're very attractively valued. You don't have to pay a lot for that inflation protection. But in the environment that the economy is slowing down potentially significantly, and some of the indicators I pointed through, that's not necessarily an environment in which we would see inflation moving off. I think it's more a case of it being sticky, stickier than you'd expect during a period of a kind of weak economy, rather than, you know, a marked rebound in inflation. But let's just take the scenario that inflation does, for whatever reason, pick off. Let's say we have another energy crisis precipitated by deterioration in the situation in the Middle East, which is a very foreseeable scenario from here. In that situation, you've got a number of tensions. You have a deterioration in geopolitics, which tends to lead to a bit of a bid in safe haven assets. You've got energy prices going up, which can lead to a slowing economy, which also tends to be reasonable for treasuries. And you have the inflation-protected nature of, offsetting that, if you have a rise in inflation, that does tend to lead to a sell-off. I think what's different about the setup today to kind of 2021, 22 is the starting point of real yields. Essentially, they're positive in every major developed world market other than Japan. So I think what really turbocharged the move in 21-22 was the fact that yields started from essentially their lowest ever position, which meant not only did they move a long way, but they moved with maximum convexity. A movement in interest rates when you start with very low yields leads to a larger price movement than if yields move from a starting higher yield. So if we had an unanticipated burst of inflation, I think from these areas, from these starting points, I don't think we would necessarily see a large sell-off in bonds, particularly index-linked bonds. I think so. We wouldn't expect anything anywhere near as stark as 2022.
I would just add that, of course, those TIPS holdings are, in aggregate barbelled in structure, and the convexity at the long end offers a more asymmetric risk-return outcome. And of course, the currency in that scenario will also help.
Brilliant, thank you. I'm just thinking we might go to there's another question around the sort of inflation question, so I might go to that one next. We've been asked, when thinking about the characteristics of defensive assets, traditionally what we've wanted to defend against is recession/deflation. Today, given the great reflation, should we instead be defending against inflation?
Yeah, so we have always been very conscious of defending against inflation, ultimately going back to the mandate where we are seeking to deliver positive real returns, i.e. positive returns after inflation. You need to be very conscious of that. I think what made it particularly difficult in, say, 2021, 22 was that all asset prices were extremely elevated. So you had strong negative real yields on bonds. So even though index-linked bonds are ultimately, you are not, if you hold the bond to maturity, exposed to inflation risk. We just saw a massive repricing of all assets, with the exception of certain kind of areas of, essentially AI tech, and certain parts of the tech kind of US equity market. We absolutely, we have large amounts of inflation-protected securities within the portfolio that are priced to deliver positive real yield. So we absolutely are focused on defending against inflation.
Great. And slight move on to something a little bit different, although you've just mentioned technology. We have a question on why we haven't taken a position in tech during the last 10 years.
To put it, Hassan will probably give an answer, but to put it bluntly, because we got it wrong, we don't. It's very important within investment management to focus on those areas that you understand and that you have in our, an area of competence. For us, it is focusing on investment trust discounts and opportunities that emerge out of the illiquidity within our universe. And the reality is, over the last 10 years, you've not seen large technology trusts or large US equity trusts with significant discounts. The discounts and the opportunities have been elsewhere, so we have been focused elsewhere. I think if we had our time again, we certainly would have sought to get more technology into the portfolio. But that has been our greatest sin of omission over the last 10 years. I guess we hope that maybe the inverse will be true over the next 10 years. These things do tend to run in cycles. Hassan, I don't know if you have any other thoughts.
These are great businesses. That's not what we're contesting. I think that if you look, is it the Nasdaq Cape is touching 50 or near enough, and that makes me queasy. I think the growth assumptions that you'd have to believe, not just today but in the future, are quite extraordinary. And I think the other challenge is the level of volatility that these stocks introduce, particularly when it's concentrated in this way, is not necessarily something that's consistent with a wealth preserving mandate. But Alistair puts it, our underweight to the US, in hindsight, is something that we've reflected on, and this our underweight to technology stocks has been an omission.
Well, thank you, guys. That's super clear. I have one more question, and then we're sort of looking like we're coming to the end of the hour. So one more question. Are there any deflationary forces remaining in the global economy? Weak yen, China not stimulating, a falling oil price, they've all gone.
Yeah, absolutely. I mean, if we look at some of these indicators of economic weakness, a lot of these could be considered as, if not deflationary, at least disinflationary. I think the reality is that, essentially since fiat money since the end of the gold standard in 1971, we have never really seen a period of deflation other than maybe for extremely short periods. So it's not to say it can't happen, but we put the risk of some kind of wide-scale deflationary meltdown fairly low. But we would absolutely kind of acknowledge that there are a number of there are a number of factors that are driving the current disinflationary environment, and if the economy continues to slow, those trends remain in place. I think we will still see inflation higher than have been associated with historic disinflationary periods, because we have in our view, at least a structurally higher inflationary environment. But that is not to say inflation will be, we're necessarily forecasting inflation to be particularly high in the next 18 months.
I think it's very easy to anchor a bit like inflation expectations on people's recent experience, but the market has historically underestimated realized inflation, and that's the evidence. I don't think on a secular level, when you look at long-term forces, not all of those are necessarily disappeared and the verdict is still out. I don't think the transition to net zero will be free. I don't think that trade tariffs are necessarily going back to where they were, particularly if we have a Trump presidency. We're not going to get the same energy dividend from Europe and Russia. Then there's demographics to consider. There's war and defense. I think there is sufficient discretion in there to make a case for all of those factors. But importantly, inflation insurance against those is historically cheap. And so if you have that view, I think it doesn't take too much to insure yourself against it.
Fantastic. Thank you all for taking all of those questions that have come through from investors. And of course, any further questions that do come through, the team will be able to review those and publish responses where appropriate to do so on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which is particularly important to you and the team, Sophia, if I could just ask you just for a few closing comments, please.
Absolutely. Thank you so much, Paul. Well, thank you everyone for joining us for today's webinar and for your very good questions for the team. I hope we've given you some insights into the CG Asset Management current thinking. And as I said at the beginning, if you would like to see the team in person, do get in touch about our Investor Day on the 5th of November. Thank you, Alistair and Hassan, and have a lovely day, everyone.
Fantastic. Well, thank you very much indeed for updating Investor Staker. Please ask investors not to close this session. You should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of CG Asset Management, we'd like to thank you for attending today's presentation, and good morning to you all.